Looking at risk profiling, I see you've put out a report, and I like to go straight to the analogy in terms of the risk profiling and the types of questions that are asked of clients that need to fill out these reports. And you allude to being asked whether you take insurance on your car in terms of premiums, would you choose what amount of excess you choose, and you kind of draw the conclusion that that doesn't give you the right data flow to accurately risk profile a client.
Absolutely. I think risk profiling is fundamentally flawed. If you ask someone whether they're going to insure their car and they say no, that's just plain simply stupid. It gives you no indication.
I mean, they're not an aggressive risk taker.
Absolutely not. And I think profiling creates consequences, as we see in any case of profiling, that has significant unintended consequences. The very simple way that one can ensure that you're doing the right thing for a client is making sure you understand where they are and where they need to go to. What the risk profile is a consequence of a variety of other factors which by and large have nothing to do with investments. What is critical for any investor to understand is to say, what investment decisions I take, what is the implication and the risk implication of where I'm investing on whether I will achieve my objectives or not. So that, for me, is the fundamental issue. Profiling, a lot of nonsense.
But Wayne, don't fund managers, financial planners all rely on this risk profiling?
Financial planners do. I mean, understand the background. And it seems a terrible thing to say about an industry that I work in, but up until, I don't know, 15, 20 years ago...
We've come to expect anything from you, Wayne.
Up until 15, 20 years ago, you sold on commissions. The product that had the highest commission sold. Then the industry started to become more sophisticated, I think, and then legislation came in saying you must sit with your client and do a financial needs analysis and et cetera, et cetera, et cetera, et cetera. And risk profiling has one of these elements to it. And then people have devised, as with the car insurance, but I've seen literally 50 or 100 other questions that tries to do the same thing, saying, do you like horse racing over the weekends? Do you go gambling on horse racing, or do you watch Tiddlywinks competition? And from that, what's your risk profile? But I mean, Andrew is quite correct to say, you here with so much money, you want to get there. Here's your income, here's your cash flow needs. If your son or daughter is going to university in 2 years' time and you need 50,000 Rand a year in 2 years' time, doesn't matter what your risk profile is, you can't put that capital at risk in 2 years' time because you need it. So it's more a needs analysis or a financial needs analysis more so than risk profiling. Because, I mean, and I've said this plenty of times as well, I've never met a long-term investor in a falling market.
Never met a long-term investor in a falling market. Looking at the risk profiling, how stringently do financial planners adhere to the risk profiles?
I think many people approach risk profiling and make use of it in what I often refer to as the CYA approach, and that's to cover
your whatever.
Cover your, let's say, back. And they feel that by doing that, they've met the requirements of the regulations, where quite simply they haven't, in my humble opinion. So many people do make use of it because they see it as a shortcut and an easy way to comply. I think the consequences, as we see, of risk profiling, where people make use of it, is, as Wayne indicated, if I'm retiring in 30 years' time, and because I might view myself as conservative now because the market might be slightly volatile, and I put all my money in cash, in 30 years' time, I'm going to be in serious, serious trouble. So risk profiling has that significantly negative consequence.
Now, Andrew, slightly off the subject of the financial advisor and risk profiling, given all the legislation into the industry, don't you think people are going to err on the side of caution, almost as a necessity because of the legislation? Because, I mean, I must say, some parts of the legislation, you can get sued for advice that you've given that the person didn't even act on. That, you said to the guy, buy a green car, they went and bought a red car, and you can still be sued for giving them advice to buy the green car, even though they didn't buy the green car. I mean, I just don't understand that logic. But besides that, if the industry is being forced to be too conservative because of legislation, are there unintended consequences? In other words, will this almost force people into a more conservative, for want of a better word, profile than what they actually should be in?
I'm not sure I agree with you that legislation is forcing people to be more conservative. What I think the legislation and regulations are doing is making sure you understand your clients. And I think the more that is done in that regard, the better, because I'm of the opinion that financial planners and wealth managers spend far too much time looking at the markets and trying to interpret them when they actually have no skills and ability to do that,
well, and
spend less time on actually understanding what their clients' needs are. I think the key issue is making sure that you can explain to a client where they are and where they need to get to. And for that reason, as an aside, I have a significant problem with the changes to Regulation 28 of the Pension Fund Act, because what that's doing is forcing people to be recklessly conservative. And if you look at the replacement ratios that are being forced to be accepted because people aren't allowed to invest to ensure that they can sustain their lifestyle, that is a problem. So legislation and regulation is in many instances well intended, but does have unintended consequences. And I think we need to make sure that our clients fully understand that.
If you look at the investment universe available to you, and obviously you look at your client and you put together a bespoke portfolio in terms of their needs analysis, but would you be able to generalize in terms of what you are doing with clients' money at the moment, where you are seeing opportunities, what assets you are allocating heavily to?
I think very simply, if you are focusing on your clients and making sure you understand their needs, the sort of machinations and the noise in the system in the market, you should look less at for a short-term perspective. But when markets are volatile, it creates significant opportunities if you have a long-term perspective. So right now...
Do you like equities, in other words?
Absolutely. I think equities are critical and fundamental to every single portfolio where you require a long-term real rate of return, which is every one of us. We need returns in excess of inflation, and apart from equities, you can get it with property, but equities in the long run unquestionably will give you the best return. Right now, you're going to have to take a little bit of pain and suffering with the volatility, having been pretty much flat, but it's not flat this year. It's up and down and ended where we started. However, with that, you have to have some equities, and then when things like this are happening, you need to explain to your clients the consequences of that, understanding the risks of their objectives, and looking longer term, making sure they do not panic. Because when you panic and try and get out the market, you have to make two decisions. One to get out and another one to get back in. And that is not one decision, it is two. When and how you're going to make the decision to get back in. Most people do not have the ability to do that.
And most people don't have the ability to sit through the volatility, because it's one thing to say, try and get your clients not to panic. But the reality is when you see your wealth being depleted, they do panic.
Being human is a detriment to being an investor.
Absolutely, and that's why...
You're coming up with some perlers this evening, Wayne. I'm going to keep repeating you. In fact, I'm going to do a little book, Wayne's Perlers.
Sayings. Yeah.
But I think the key thing there, and that's looking at research as to why people panic. All our research indicates that most people panic for two reasons. One is they do not have a framework and understanding of what they're trying to achieve. So when the markets sort of go into a bit of a wobbly, like we've had, they then lose perspective. So you have to make sure that your clients understand what they're trying to achieve. And the second thing, your clients have to be very comfortable, investors have to be comfortable with who they are. And there's some interesting research there about happiness and money. Ironically, the more money you have doesn't make you happy, but the happier you are and content you are with yourself, the more successful an investor you are.
Money doesn't buy you happiness, but it does help you sleep well at night.
But it makes misery a lot more fun.
It makes misery a lot more fun. Definitely a book coming from Wayne McCurry.